Well, happy Friday, folks. I'm going to summarize today in one word. Ouch. And I'm going to explain to you guys why the Treasury yields are going up, and it's all about oil. So basically today, our lesson is going to be, why is oil really affecting mortgage rates? And they're going to go higher today, and I'm going to explain to you guys the whys behind it. Because if you're watching this, you're hopefully a mortgage loan officer. You know what I go over each day. So, okay, we got mortgage rates. They were down yesterday. I told you they would be down right about 6.5%. They ended at 6.52. Well, that's ending today. So here's what I got up. I got up this morning, and I go to the news, and I'm like, okay, there's no economic news today. That's great news. Well, then, like I start every day, we start with the chart, and I go in here, and it's like down 30 points, and I'm like, what in the world is going on? So, folks, mortgage bonds are crashing right now. This means mortgage rates are going to spike, because that number up through there, that's all we really focus in on in this channel. If it's red, that's bad news. That means mortgage rates are going to go up. The bigger the number, well, the bigger the adjustment, and 60 is a whopper. So what happened today? Well, let's talk about it. So here's what I want to do. I want to put you guys in the catbird seat today. I want to put you guys as the federal chairman, and you're going to look at the data that we got this week, and then you guys tell me what you would do with interest rates. Okay, so that's what we're going to talk about today. I'm going to also show you the correlation between oil and interest rates, and how oil pushes up inflation. Inflation pushes up the cost of everything, and then that ultimately pushes up rates. So you're thinking, okay, the oil prices are already making things more expensive, so why would rates go up? You're in for a lesson today. So we're looking at the chart. It is minus 61 so far. We end the day. At the end of this video, we'll come back to this, and we're going to see where this goes. But minus 61, this is bad news for the day. So let's get to the first piece of the puzzle. Why? Well, oil spiking right now. We got, I guess we were hoping to get more resolution from the China situation or the China meeting, and it doesn't really look like there's much going on. I think the markets are finally saying, okay, if this thing's going to continue, well, we're going to have inflation continue, and that's not good news for the market. Let me show you one thing that the markets also missed this week. Probably you did too. You realize we have a new Federal Reserve chairman. Okay, Federal Chairman Powell, he retired. Basically, his term was over, but he's staying on at the Fed. It's only happened 3 other times in history. So he's kind of staying there, just kind of give it to President Trump. But they're saying, good luck. You're going to need it. Okay, so let's get over the data that he's looking at. So the Federal Reserve, they were created for 2 reasons. 1, to keep inflation in check, and 2, to keep jobs at full employment. So let's get over to this thing right through here. Here's why they were created. Okay, so they control that rate over there. It's called the federal funds rate. What happens with that is when banks need money, banks need money sometimes as well. At the end of the day, let's say Citibank needs to have $1 billion in assets to close down for the day. Well, if they don't have the money, they go out and get it lent to them from another bank, and that's the interest rate they pay. But the Federal Reserve, that's all they control. But they also control, kind of manipulate the bond market to a point, because they released this information right through here. The PCE, this is the personal consumption expenditure. That's the inflation number that the Federal Reserve watches. Last year, at this time, is 2.3. Okay, so if you're sitting at the Fed, you want that thing to be at 2. Now it's at 3.5. It's probably going to go even higher, and I'm going to show you the economic news we got this week. Then I'm going to show you what's coming down the pike next week. It's kind of a drab week next week, and how that data is going to affect rates. So we also got employment numbers last week, and the employment numbers, we have nothing to worry about right there. Okay, and GDP, it's growing pretty good. So let me go over to these numbers right through here. Here's the information we got this week. And honestly, yesterday, I thought the market was going to implode. Over the last couple days, we got some inflationary numbers, and I'm like, okay, these numbers are bad. So let's just let's recast what we got on Monday. We have existing home sales. Last reading was 4,000,000.01. They were supposed to go to 4,000,000.05, and they came in at 4,000,000.02. I'll say that's right on point. People are saying, oh, this is crashing. Well, we've had about 4 million houses selling kind of on a consistent basis over the last few years. So the consistency there is pretty good there. Then here's where the inflation numbers start to come in. Tuesday, we had consumer inflation. This is the stuff you and I kind of pay attention to. You're going to see the CPI. It includes gas and everything else. The CPI year over year went from 3.3 to 3.8. Nothing huge. And that actually shocked me as well. I'm like, okay, this includes oil, which in April, oil was $120 a barrel. So I figured this number could blow out the roof. Okay, but 3.8, I'll still say that's really high, but that's not as high as the markets kind of would expect. But okay, let's keep scrolling. Then the next day we got the PPI. Let's add in some more data here because I two filtered it or one filtered. Let me show you something. Because yesterday or Wednesday, hopefully this refreshes real quick. Yeah. So let's look at the numbers that we got on Wednesday. Now this is producer inflation. Okay, so what you're seeing right through here is the PPI. Last reading went from 0.7. They thought it would go to 0.5. If you go back to my news or my channel on Tuesday, I said this is going to come in higher than 2.5. And not in my wildest dreams, I thought it was coming at 1.4. Okay, so month over month, they said inflation went from 0.7 to 1.4. They equated out this to come in at an annual basis. Inflation's at 6% on the producer side. It eventually has to work its way over to the consumers because you have a lot of earnings reports just blowing out the numbers. Okay, and then you got through on Thursday, we had continued jobless claims and everything else. They're on point, so no new news there. And then Friday, I come in and I'm like, okay, there's really not too much here. Well, the markets didn't like whatever came out. So let me give you some information on this. Here's how inflation works. Let's look at oil. Okay, we're going to look at oil, and I'm going to show you the correlation between oil and how inflation works. And we're just going to show you how a lot of people think, okay, inflation's up 8% last year. Oh, that's bad. No, I can't wait for it to get back to zero because prices will go back to where they were. Doesn't work that way. Okay, so let's go back. What I did is I went back all the way to 2015, where, basically the inflation numbers were what we kind of normally had. So if you go back to those times, you can see basically from 2016 to 2020, it was about the consumer inflation. This is the number, kind of one of the numbers that the Fed wants at 2%. It was there. And the Fed cut. They were cutting, and they continued to cut rates and keep them low a little too long. Okay, so then what happened is inflation started to really peak. Okay, what happened right through here? What happened through there? COVID. Okay, so you're thinking, okay, how did things spike up so high? Well, think about it. During COVID, people, if you didn't lose your job, you still continued to get money there. If you got COVID relief, you got money on top of that money. And then if you had a student loan, the two biggest debts that you probably have is student loan debt and a house payment. If you had a loan that was with Fannie Mae or Freddie Mac, you didn't have to make a house payment. And then if you had a student loan, you didn't have to make a student loan payment. So during these times, consumers had the most money in their pockets ever in history. And then it kind of depleted right after that. What happens when you have way too much money chasing way too few goods? Well, inflation. Okay, that's what causes inflation. But here's what a lot of people don't understand. That inflation doesn't go away. It just keeps compounding on itself. So if you went from 2015, you added all this inflation and you compound it, it equates out to our inflation is up 35% since 2015. So that means your dollar is worth less. Now, let me go over here and I'll explain to you how this really matters for interest rates. Okay, so here's what's going on with interest rates. Okay, so what you normally have is right there here, you have the annual inflation numbers. Okay, the 10-year Treasury is, think of a bond. You want to invest in a bond, and that's this chart that we watch through here. This is telling us what the price of the bond is doing. Okay, so if you go over to here, this is saying, okay, inflation is in the red. Okay, but what bond investors have to do, they have to say, okay, inflation is deteriorating our dollar, and if we want to invest in something, at least to have security in our money, let's go into maybe a 10-year Treasury, something really safe that kind of monitors inflation, but we want a margin there. So if inflation's at 2%, what it normally is, as a Treasury buyer, I'm okay with a 3% yield. I got a 1% return on all that money. So that's what they usually have, a 1 or 2% cushion. Well, you can see this over time. It usually plays out pretty well, and sometimes it doesn't work out, and sometimes it really doesn't work out. So now, right now, the bond market's kind of playing catch up. So what the bond market's saying now is, where's inflation? What's it at? Is it 6? Is it at 2? Is it at 3? Is it at 8? So then they're going to use the numbers accordingly to figure out where bond yields go. Hopefully I didn't lose all you guys. So that's how bonds and oil and everything affects inflation, which ultimately affects mortgage rates and bonds. So that's the lesson for today. So let me go into the news that we're getting next week, because this is the doll numbers we're getting. Next week, there's really nothing coming out. Each Thursday, we have initial jobless claims, continued claims, and so forth, but there's really not a lot of data coming out next week. So follow oil. That's all I'm going to advise advise you in today's news. So what am I advising my clients right now if they're coming in and they have a contract? Are we playing the float game? Are we playing, okay, let's see where mortgage rates are going? I got a video coming out soon, and it's about VA lenders. And there's one out there that's trying to unite all the veterans together that they really, they're in a lawsuit right now that we're going to kind of go over. You know, most times when you get a contract in, what I'm advising my clients to do right now is lock in. Just lock in, because today, just today alone, we're going to have rates probably go up 1/8%. So if you were just kind of teetering right there to maybe you qualify or not, or maybe that payment's getting a little bit higher than you think, this news today isn't good news. So get the contracts in, lock them in. You can't afford a rate bump, you know, right during the transaction. Now, if you're looking to buy in the next couple months, you're looking to build down the road, I think you're going to be, okay, all you need to do is watch oil. Okay, so I know it was a long video today, but now you understand hopefully a little more on how oil prices really affect all these things. So as oil goes up, you're going to see inflation go up. Why? Well, because it's the cost of everything is included in oil. Think of oil as in, you know, my widget here, my cup, my phone, my everything. Oil's in everything. So as the prices of oil go up, inflation's going to go up, and now you understand why bond prices or bond yields have to go up as well. So that's that part of it. So if you get a little confused with all this, don't worry about it. I'm going to kind of tie all this up here in a second. But there was news out just recently you probably haven't heard of. You realize the first tariff refund check went out to companies? Now, I started looking into this saying, okay, everybody was making a big to-do about this. There was states suing the government saying all our constituents want their money back. Well, now some of the tariff money is actually going back to these companies. So how are we going to get it back as the consumer? They're going to promise us maybe lower prices. Are they going to promise us, I can almost assure you it's not going to work its way back to me. So if you guys want to find out some information about these and some things that are on my mind, just go to the rateupdate.com into the resource section under blogs. We have a whole bunch of things right through there to help you guys out. How inflation stays sticky, mortgage rates came down that day, and then tariff refunds, that one's just came out today. So if you're a homeowner right now, what are you doing? You're probably sitting there saying, okay, Dan, I'm buried in debt, but I really don't want to trade in that low rate I have. Or, Dan, how do I track these rates because they're all over the map? And we're going to go back to the chart here in a second to show you guys where the MBSs are. But if you're a loan officer out there, you're a realtor, even if you're a homeowner or home buyer, check out the stand store we have. This link should be down below. These are all brand new. I updated them because most of the links, or a lot of the links for some reason, got disconnected. So if you go down through here, we even just put in recently, down payment assistance right through here. If you're looking to buy a house, and maybe you're short of funds, or you're a realtor out there saying, okay, there's some down payment assistance programs out there. We know about them or whatever. Check out this program right through here. It'll actually take you and it'll scan all the programs that we have, and we have access to over almost 40 different lenders. So let me tell you a little bit about me just before we end this and go back to the charts. Folks, my name is Dan Frio. I'm actually the host of the Rate Update, and I'm also a licensed mortgage loan officer licensed in all 50 states. If you need some help with a mortgage, I'd love to help you out. Visit us at therateupdate.com. But that's my promo for the day. But let's go back and see where the mortgage bonds are taking us for the day. Minus 58 is bad. Let's go over and see a 2-day chart on this. This is even worse. Okay, so let's go to a 1-month chart. I was advising, let's go. I was advising our clients back about a week and a half ago on a Wednesday. It was right about through here. I said, guys, we might want to look at locking in. I had some refinance people sitting on the fence. They're like, let's roll the dice. That wasn't a good roll of dice. So if you're out there, you're pending or waiting on you're floating your rate, you might want to watch us every day to figure out when you should lock in, because today we're looking at pretty bad news when it comes to mortgage rates. So visit me at therateupdate.com. You can also get this mortgage channel right through here. It's our command center. Just go to therateupdate.com, hit right up through here. It says mortgage rates. What's going to pop up is right through here. These are the top 6 programs when it comes to mortgage products. We got conventional loans, FHA, VA. Down through here, you got the 15-year conventional, ARM rates, jumbo rates. Then down through here, this is giving you the indications of what actually is moving the market. Well, we follow the MBS market right through here, and this is a little delayed from the actual live feed that I watch each day, but this is going to give you what the 10-year Treasury is doing, and this is directly on beat on what's happening. Over through here, there's, like I said, there was really no economic news out today that should really affected the markets. You go down through here, the market trend for today is bad. So it's going to tell you rates are going up today and the reasons why. It's going to give you our podcast for the day. It's going to give you all the indices that we go over each day. So let's go over that. I forgot to do that right through here because I was all excited to ask you guys what you would do if you were the Fed chair. So let's go back. I'll get to that one in a second. Let's go back, and it is I think it's going to be a complete non-Cinderella story today, folks. Okay, so here's what we're looking at. The Cinderella story, what I look at is the Dow Jones, the S&P, and the NASDAQ all being green. That means it's up because if you got more money in the stock market, hopefully you're making money. Today it's not good news. Oil is up. That's the culprit behind all this. That means rates are going to go up. Now you understand a little bit more about rates. I know that was lengthy, but it was well worth it. Let's go to cryptocurrency, and it's getting hammered. So, folks, this is an un-Cinderella day. Why? The only thing I can say is maybe there's profit taking. Maybe people wanted more out of the China negotiations, and oil's pushing up, and I think that's the culprit behind the scenes. So there's no economic news out today, so that's it for today. Let's see if for Investment Club Watch, they're always pumping that stuff. So MBSs are down 57. Mortgage rates are going to jump up. If you need some help with a mortgage, I'd love to help you out. And if you were sitting at the Federal Reserve, what would you do? I surely would not be cutting rates into this environment. You guys got any questions? Please ask anything you got. Let's go over to the last piece of the puzzle, the Federal Reserve. What are they expected to do in 33 days? This gives us a chart of what the Federal Reserve should be doing in 33 days. Are they going to cut, hold rates? What are they going to do? There is a 99.2% chance they are not cutting rates at the next meeting, even though we do have a Federal Reserve chairman that's handpicked by Trump that will not be cutting rates because inflation is just way too high. So that's my predictions for now, folks. So if you need some help with the mortgage, love to help you out. Otherwise, have a fantastic weekend. I'll see you back here on Monday, the opening bell. Let your friends know about it. We're coming to you live each day now at 9 a.m. each weekday.